Okay, thanks a lot. Actually, I'd like to thank the organizers for assigning me this paper. I found it really interesting, made me think about things in a new way, and I think there's a lot of interesting things you could do with this. So my discussion, I'm going to just explain what I think is going on in the paper, and then just have some questions, and so on, okay? So the big question here is, right, I guess everybody here at some point has had to teach somebody how to calculate cost of capital, or how to do portfolio formation, or how to do some kind of practical finance thing. And some input in the model is always some kind of expected returns. More or less, my experience has been, takes a long time for the students to figure this out, even though they've taken many regression courses and done lots of stats, and it's hard for me to figure out how to predict. So this paper actually is going to try to help us understand how people in the wild are doing this, and they come up with what I think of a very sensible measure to do this, and study some of the properties, okay? And the new feature here is we're going to look at the cross-section. So we're not really focusing on time series predictions, we're focusing on the cross-section, and we've got a really interesting data set of rankings that people are providing, okay? And so there's this app called Forcerank that runs contests, or ran contests, and this Forcerank, you'd record what you thought of was going to be the best stock from a group, and these guys have the data from this. So that's like a clean measure of something related to what people are expecting stocks to do, okay? The result is that if you try to predict these rankings, they're basically, run a time series regression on historical returns. They seem to be mainly based on the last data point, so there's some kind of recency bias. Shing didn't talk much about it. You could sort of ask, are bad news or good news weighted more or less in these predictions? It seems like bad news takes more weight. Things that are salient as measured by distance of the news are more highly weighted in the rankings. You could ask, how much do people look at just some constant versus some kind of weighted average of the history, cross-sectionally across users, cross-sectionally across stocks? It seems to be related to like how much the person kind of is a finance person. They don't maybe do quite so much of the extrapolative business. Maybe it's related to characteristics of the stock, like the size. You could also think about this ranking as some kind of sufficient statistics for people's expectations or some kind of signal. So can we use it to trade? Yeah, you can actually, and it's pretty profitable. And this was depressing to me until I remembered grading lots of tests, actually. People are accurate, but they're accurately wrong. That is, the best ranking does the worst. The worst ranking does the best. So people are ignoring the mean reversion, I think is what this is saying, okay? And so that's what I mean by the highly ranked stocks revert. And if you actually tried to predict who was going to win the contest, the highly ranked stock does badly. So it's not only showing up in the stock returns, it's showing up in the actual realized rankings. But I guess that's what you expect, because the realized rankings depend on the stocks. Okay. All right, so I didn't know anything about Forcerank, so the first thing I did is I went and Googled it. And this is from their webpage. They don't do this anymore, actually. But it's not that Forcerank is out of business. Forcerank is now called Estimize, and they stayed in the business, but they refined their algorithm. And so I went to this Estimize site, and this is now what they do. It's the most accurate and representative estimates data set available, and they run some kind of crowd-sourced platform where you can put in earnings forecasts and economic forecasts. I didn't want to sign up, so I didn't go to the website, although maybe I should have. And you can't see it on that slide, but they have really like nice moving subtle images behind of stock tickers and all these people. But there is, again, I didn't know much about this. There is kind of a sector of people who run these crowdsourcing sites where they get people to try to predict the future. And I actually knew slightly a bit about them because, so Mark is a alumni of CMU who has his own fund. And he came to me in the fall because he was going to switch cities and was explaining to me how his business worked. And he told me about a site called SumZero, which is another one of these sites. And I asked him, well, what is this? Why are you doing this? And what he told me was he, every week, enters this contest, and all the marketing materials for his fundraising actually are based on his outcomes in these contests. Now, it's not the same as Forcerank, but there are people using these platforms to try to signal their abilities somehow. So it's not really a comment so much about the paper, but I think there's interesting stuff going on with these data. And it did make me wonder, which is absent from the paper, but like, what is Forcerank's goal in all this stuff? What are they trying to do? How does it work? And that would actually help me understand the paper. Okay, so now I'm going to talk about the paper a little bit. There's a model. I have a bunch of clicking slides through. I just want to say it's a perfectly compelling model. There's fundamentalists, there's biased investors. Fundamentalists know what's going on. They know how the dividends evolve. They're going to try to trade against the biased people. There's a finite horizon, so these smart people know at which date the whole thing is going to end. So if it overprices at the end, they're going to push it down. That's basically the equilibrium. I guess I wanted to show my fonts worked. But that's the power of LaTeX, I guess. I do want to make a point. It seems like, maybe I didn't understand the equilibrium, but it does seem like the equilibrium, the price, does have the same mean reversion as these forecasts. I think that's what's going on. So it's not so obvious that the people who are forecasting in this way are completely crazy, because if they did, for whatever strange reason, run the regressions that we tell them to, I think they would get these coefficients. I think that's the result in the model, okay? But of course, the model does have eventual overreaction, and that's the part that people ignore. Okay, so maybe one other point that's worth everybody knowing. This data is from a very short sample. It's from 1 year. It's from weekly data. The paper is not very clear on how the stocks that these guys are ranking, it says they change, but it doesn't tell you how they change or why, which is something I was kind of curious about. Everything is about aggregate data, but there is some individual data. What we end up doing is regressing these force rank things on lagged returns, and we basically interpret the weight on that average is how much weight they're putting on this historical data, and the mean reversion speed of that thing, like how much it decays as the extrapolation speed, I guess. Small r squareds, fast decay. There's too much decay. Okay. There's too much decay relative to even if you're just trying to predict these rankings. So nobody knows how to do the regressions. But the big thing is the sign flips. Okay, so the outcome is, this is pretty compelling. These guys don't understand anything about time series. I barely understand much about time series, so I'm not surprised. As a profession, we spent years trying to figure out this mean reversion thing, so it's not surprising that it takes these random guys to figure this out. But there's a recency bias, and nobody gets the mean reversion. Okay, so of course, when I see this stuff, I try to figure out what's the benchmark. So I sat down and said, well, what would be a model for predicting outcomes here? And so what I did is I said if I had two stocks that followed the market model, so this A, that's maybe your estimate of the average return. Maybe that's what you're learning about. Maybe you have some kind of beta on some sort of factor, some sort of risk, the epsilon, and some sort of forecast error. And if I wanted to know what's the probability that stock A beats stock B, if everything was normal, I'd use some kind of probability model. Okay, so my point is not that you shouldn't use linear prediction, use linear models. My point of writing this down, so first of all, with 10 stocks, I'd still be typing the equations. But my point is, look at the variables that show up in there. If I'm trying to predict the best of 10 stocks, I've got to get the expected return of the first stock, the second stock, the third, fourth, up to the 10th stock to calculate this thing. So it seems like my ranking of the stock shouldn't just depend about my expectation of that one stock, but should depend on the expectation of all 10 of the stocks somehow. And so the point I'm trying to make here is it would be a nice thing to see in this data if you put the whole vector of expectations in the rankings. Does it have any power? Okay. I think you can show that people don't even do this in the model. So I think there's even more behavioral bias in these guys. Okay, so you need to put I would recommend trying to put multiples in and just showing whether it shows up or not. Again, I vaguely remember having to learn about these probit models. What you do learn about these things is the residual, you have to assume it's got a standard deviation of 1, because you see all the coefficients on these things, they're all divided by the risk or the volatility terms. And so I think what that must mean is, especially when you're comparing 10 stocks, the coefficients on this, even the linear projection of this thing, would be switching around. So volatility should be important here. And so I think that suggests that there's interesting time series things you could look at in your data. There's interesting cross-sectional things you could look at in the data. And that might help us understand some of the cross-sectional results, and it might allow you to get sort of better tests of some things. So you could drill down into your data in different ways. I would never suggest estimating something like that, but the linear version could tell you something interesting. So my next stuff, just say this, but just maybe try to think about using this to drill down on some of the results in this paper. Okay, and so the one that seemed obvious to me is a third of these guys are finance professionals. Probably they have more confidence in their models, and that might explain why their weights are different. And sometimes the market is more or less volatile. That might explain why the markets are different. Okay, so then the other questions I have, what's the dispersion in these rankings? So we have lots of models now where people are thinking about heterogeneous beliefs and heterogeneous craziness or something. This paper could provide you actually a nice series of the heterogeneity measure. And I think that would be really interesting, and you could do that. People are adding and dropping out of this thing all the time. Do people change their strategies? There seems to be this week where you see your outcome before the end. Maybe you can't use it in this thing, but you could probably use it in the next. So how does that work? Is everybody learning here? Who stays, who leaves? Maybe there's other papers trying to understand, do the really sentiment people just quit this? Or are those the guys that are staying in the platform? How is this platform picking stocks? How does it change? I kind of wanted to know that. I didn't actually even understand the regressions because there's all these different stocks in there. That would be helpful to understand the paper. Okay, so this was Jonathan's point. The authors take the stand that there's no tournament incentives here, but if some of the people on this are acting like my ex-MBA student and using this to raise money, they are in a tournament. So I'm not so sure that just expected ranking is the obvious objective function. It's not maybe about this paper, but this paper might be a good or these data sets might be a good way of trying to understand that. And I think probably people aren't just looking at expected outcomes here, okay? All right, so we're at the last slide. This is a really useful paper. It is a nice, clean estimate of rankings. Lots of evidence that people aren't able to do statistics. It's a good idea to use the rankings, but there's more to dig out of this. I believe the results. I think they're sort of true. This is exactly the same thing that Xing said. This kind of data and more of these data, we should be studying it more. It's a good set of field data to understand expectations formations, and coming up with things for this is great. So thank you for your attention, I guess.